wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the global financial markets. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 211, and in this episode we're reviewing the performance of the financial markets during the 18th week of 2026, and that is from Monday the 4th to Friday the 8th of May. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where if the Federal Reserve still has any reasons to cut interest rates in the near future, they're getting harder and harder to justify. Case in point is the Friday's jobs report for April that provided the latest evidence that the central bank's larger concern isn't a flagging labor market, but rather the cost of living that is getting increasingly harder for ordinary Americans to cope with. The Nonfarm payrolls increase of 115,000 new jobs in April is yet another sign that the jobs picture has stabilized, at least enough to reduce the pressure for further rate cuts. By comparison, there is scant evidence to say the same for inflation, and this is likely to push the rate-setting Federal Open Market Committee into a more hawkish stance going forward. Staying stateside, the Bureau of Labor Statistics reported on Friday that job creation in April exceeded muted expectations, though the struggling U.S. labor market showed signs of a potential slowdown later this year. Non-farm payrolls rose by a seasonally adjusted 115,000 new jobs in the month of April. This was down from 185,000 jobs created in the previous month of March, but was still much better than the Dow Jones consensus estimate for 55,000 new jobs. The employment report showed that the labor market has been pretty stable over the past year and a half, as the unemployment rate continued to hold steady at 4.3%, which was further proof that the labor market has reached a point where only modest job creation is needed to keep the unemployment rate steady, given the modest growth in the U.S. labor force. Additional data from the states, where according to a University of Michigan survey that was released on Friday, rising gas prices due to the Iran war has sent consumer sentiment to a new low in the early part of May. The closely watched consumer sentiment survey posted an interim reading of 48.2, which was down by 3.2% from the previous reading in April and was down by 7.7% from 1 year ago. According to the survey, inflation fears were the primary driver for the continued trend lower in consumer sentiment. And over to the Far East, where after multiple warnings against the speculative and one-sided currency moves, Japan's Ministry of Finance appears to have put its money where its mouth is and intervened in the currency market to support the weakening Japanese yen. The first intervention reportedly took place on the 30th of April and came after the yen weakened past the politically sensitive $160 to yen level, marking the first yen intervention operation since July 2024. According to LSEG data, the yen appreciated by as much as 3% on that particular day. The yen appreciated sharply again on Wednesday this past week, fueling market speculation that the Ministry of Finance had stepped into the currency market for a second time in as many weeks, as the yen appreciated by almost 2% to trade at around 155 yen to the US dollar. While a stronger yen typically erodes the profit margins for Japanese exporters and makes their goods less competitive, a weaker yen raises the cost of energy, food, and raw materials, which Japan is heavily reliant on. According to Reuters, Japan's finance ministry may have spent as much as 5.48 trillion yen, which is equivalent to $35 billion, in order to support the yen during the first intervention on the 30th of April. On Wall Street this past week, U.S. equities rose on Friday following a better-than-expected April jobs report and as traders eyed developments between the U.S. and Iran. Sentiment was bolstered by a better-than-expected Nonfarm payrolls report for the month of April, which showed that the U.S. economy created 115,000 new jobs as the U.S. jobless rate held steady at 4.3%, which was in line with market expectations. All the three major averages posted weekly gains propelled by strong earnings from the tech sector, as both the Nasdaq and the S&P 500 posted 6 straight winning weeks and closed at record highs, with the tech-heavy Nasdaq Composite rising by 4.5% during the week to close at 26,247, whilst the broad market S&P 500 gained by 2.3% to end the week at 7,398. Meanwhile, the blue-chip Dow Jones Industrial Average was the laggard for the week, with a marginal gain of just 0.2% before settling at 49,609. In the bond market, Treasury yields edged lower on Friday as investors looked past a solid April jobs report and focused instead on the prospect for peace in the Middle East that would further ease energy prices and reduce inflationary pressures in the U.S. economy. Treasury yields remained lower after the better-than-expected payrolls report, and as the yield on the 2-year Treasury note, which moves in line with the Federal Reserve's interest rate policy, this slipped more than 2 basis points to close at 3.89%. Meanwhile, the yield on the benchmark 10-year Treasury bond, which is a benchmark for mortgage lending and credit card debt, this fell more than 2 basis points to settle at 4.36%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move inversely to one another, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, oil prices ticked higher on Friday after Iran once again fired missiles at the United Arab Emirates, and the U.S. struck 2 Iranian tankers as they tried to evade its naval blockade. The attacks came as Iran is reviewing a U.S. proposal to end the war, and as the U.S. Secretary of State said that the U.S. was expecting a response from Iran on Friday. However, the 2 major oil contracts posted weekly losses of more than 6% as market hopes for a deal to end the war in the Middle East. In response, the international benchmark Brent crude added around 1% to close at $101.29 per barrel, whilst the US benchmark, that is West Texas Intermediate crude, settled marginally higher at $95.42 per barrel. In the precious metals market, as prices ticked higher on Thursday, market players are speculating that the rally that propelled gold and silver to record-breaking highs in 2025 could pick up again in 2026, but only if the US and Iran reach a comprehensive peace agreement. Gold and silver both enjoyed record-breaking rallies in 2025, surging by 66% and 135% respectively. However, both metals have seen much more volatile trade in 2026, with silver suffering its biggest single-day blowout at the end of January, and with gold falling more than 10% off its January peak. Amid hopes that the US and Iran could be nearing a deal to end the war, the price of spot gold jumped by 1.2% to close the week at $4,750 per ounce. In the cryptocurrency market, a major rules of the road bill for the crypto industry is set to get an initial vote by the Senate Banking Committee on the 14th of May. This step to move the legislation forward is a loss for the banking industry, as banks have argued that the proposed legislative language limiting when stablecoins can earn interest is very similar to yield-bearing products like savings accounts and could threaten traditional banks and their deposits. For your information, historically, interest in the form of rewards has been a key incentive for crypto users to hold stablecoins. Crypto companies are now on board with the proposed legislation, and this comes after the introduction of a compromise proposal on how crypto companies could offer rewards to stablecoin users that wouldn't compete with the yields that banks offer for customer deposits. And once again, just for your information, stablecoins are a digital currency that is designed to maintain a consistent value by being pegged to a reserve currency like the US dollar. We now change scene to the Kenyan financial markets, and as is the norm, we start by looking at the domestic foreign exchange market, where the Kenya shilling remained static versus the US dollar this past week, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.19, which is the exact same rate that was recorded the previous week. Meanwhile, the sterling pound was priced at 175.77 and the euro was valued at 151.80. And on the regional front, one Kenyan shilling was changing hands for 29.23 Ugandan shillings and 20.06 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.31. The International Monetary Fund has previously raised concerns about the extreme stability of the Kenyan shilling, but the central bank continues to insist that it operates a floating exchange rate policy. However, the data tells a different story, as the dollar shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenyan shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 65% of total revenue collections. On foreign exchange reserves, During the past week, Kenya's usable foreign exchange reserves increased significantly by $188 million for a grand total of $13.41 billion, which is equivalent to 5.7 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was liquid and remained well funded with the support of the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya Shilling Overnight Interbank Average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate remained unchanged at 8.75%, which is in line with the central bank rate, which is at the same rate of 8.75%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 32 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 7th of May, and the central bank received bids totaling to 29.4 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 122%. The central bank accepted almost the entire amount offered, and the results of the auction were as follows. The 91-day rate increased by about 15 basis points before settling at 8.18%, whilst the 182-day rate was flat at 8.21%, and the 364-day rate remained unchanged at 8.51%. Please note that just 2 weeks ago, the TBILL market appeared to be reversing its downward trend, and this was on the back of the first supplementary budget for 2025-2026, which pointed to a massive increase in the domestic borrowing target of about 360 billion shillings. And with the latest data showing inflation trending higher due to the impact of fuel prices, we should expect more upward pressure on interest rates as investors park their funds into the 91-day Treasury bill, which gives them the opportunity to reinvest at a higher rate in the short term. In the primary bond market, the Central Bank of Kenya had previously published a prospectus for the reopening of 3 fixed coupon treasury bonds, in which it was looking to raise a total of 80 billion shillings for the stated purpose of budgetary support. The auction for these bonds was held on Wednesday, the 6th of May, and the central bank received bids totaling to 106 billion shillings against an advertised amount of 80 billion shillings, representing a performance rate of about 132%, and the results of the auction were as follows. For the first bond, which is a 20-year bond that was initially issued in 2012 and now has 6.6 years left to maturity, the central bank accepted 47.5 billion shillings at a weighted average rate of 12.45%, and this is compared to the bond's coupon rate at 12% flat. And for the second bond, which is a 20-year bond that was initially issued in 2019 and now has 13 years left to maturity, the central bank accepted 14.5 billion shillings at a weighted average rate of 13.21%, and this is compared to the bond's coupon rate at 12.87%. And for the third bond, this is a 25-year bond that was initially issued in 2021 and now has 20.1 years left to maturity. The central bank accepted 31.9 billion shillings at a weighted average rate of 13.69%, and this is compared to the bond's coupon rate of 13.92%. Up next is our topical issue, and this week we are looking at Safaricom's historical milestone as it surpasses 100 billion shillings in net profit. The highlight of the week was Safaricom becoming the first Kenyan company to surpass 100 billion shillings in profit from its domestic operations. Safaricom's Kenyan unit recorded a profit of 118.3 billion shillings, whilst the group's total net profit jumped by 36.9% to 95.6 billion shillings. This performance was driven by an 11.5% growth in total revenue, which exceeded 400 billion shillings for the first time. The company's success is largely attributed to M-Pesa, which saw revenue grow by 13.4% to 182.7 billion shillings, which now represents nearly half of the company's total revenues. Additionally, the company's strategic shift into mobile data and fixed internet helped offset saturation in traditional voice and SMS sectors. A significant reduction in losses from the Ethiopia expansion also bolstered the bottom line, as the losses in Ethiopia dropped by 35% to 21.2 billion shillings as the firm better managed the depreciation of the Ethiopian birr. This record profitability translates to a massive windfall for investors, with Safaricom announcing a total dividend payout of 80 billion shillings, which translates into 2 shillings per share. This represents the highest dividend payout by any company that is listed on the Nairobi Securities Exchange. Following the announcement, Safaricom's share price rose by 6.8% to 32 shillings and 10 cents, marking a 13.2% gain since the beginning of this year. And as Safaricom looks forward, it views Ethiopia, which is Africa's second most populous nation, as the primary engine for its long-term future growth. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the only person you're destined to become is the person you decide to be. A quote by Ralph Waldo Emerson. Think about it. Thank you, and God bless.